Alright guys, listen up. It's time to talk about share portfolios. Hopefully you watched the previous episode, which was the basics on shares and how they all work. Now we're going to talk about putting together a portfolio. Now, I think you should put a portfolio together of great YouTube content creators such as me and subscribe. The worst pun I've ever done. Still hope you do. Anyway, let's talk about portfolios. First of all, remember, I'm not your financial advisor. I don't know your financial situation exactly. I'm giving general explanations on how the market works. Don't copy everything I do. I'm not a genius. I'm a guy on the internet covered in tattoos with a Panther shirt on, all right? Let's just relax. With that in mind, I'm an expert at this, so let's go. What I'm thinking about when I'm thinking about putting a share portfolio together. I'm going to use me and my situation as an example because I don't know everyone else's. You can amend it and understand the factors in it according to how you are. I'm 34, I don't have any kids, I have a full-time job, and I'm investing for long term. So when I'm thinking about buying shares, 90% of the time, my intention is to never, ever, ever sell them. I just want to tick along with them. What this means is I'm looking for primarily really strong companies and really strong funds that will just slowly grow and will just spin money back to me. I'm not looking for zany investment mining plays. I'm not looking for any weird shit. I'm just looking for stuff that I can put there, forget about, and get a check twice a year from dividends. How I balance my portfolio. Firstly, I'm only investing in Australian shares because I don't want to have to deal with overseas tax. I want exposure to global shares though, but I don't want to have to deal with all the tax bull of holding global shares. So I look for ETFs or exchange traded funds that do that. An example is Paxx, P-A-X-X, which I currently hold, which is Platinum Asia Fund. This is a fund that specializes entirely in shares in Asia. I want exposure to Asia because it's a rapidly growing and modernizing marketplace. So I got some shares in Paxx. Another example of overseas shares is Pixx, which is Platinum International Fund. This is a basket of shares from all around the world that gives me exposure to the global share market without having to hold them all and deal with them all. So at the end of the year, I get a statement from these companies with all the stuff filled out and I just type it into my tax return and it all gets taken care of. It also generates wild yields, like just crazy dividends. In the last 6 months, the Australian share market has gone up nearly 10%. I want to get on that train because I want to make some cash. I don't want to have to buy 200 different companies, right? So what I can do is buy an ETF for the Australian ASX 200, which in this case has the code STW, which is Spider's 200 ASX fund. So all I do is buy units in this and hold them, and they mirror the way the Australian stock market runs. They're a really good one I like to hold as well because I don't have to do anything with them and I just ride the wave. So when I look at my portfolio, the majority of shares I have are ETFs, exchange traded funds, because I don't want to go to the hassle of picking individual stocks, but I can see trends in the distance that I want to follow. I do hold shares in things like Wesfarmers though, which owns Officeworks and Bunnings, because they're consumer staples that are always required. So if we look at Wesfarmers, the ASX code is WES. They have $30 billion revenue, not bad. Profit of $2 billion. They pay $1.70 a share dividend, that's pretty good. The price earnings ratio is 33, which is about the middle. And their overall yield is 2.99, so basically 3%. So that's pretty good to have. And when I look at a company like Wesfarmers, it's a super, super safe play in my opinion, because regardless of what happens economically, people are always going to need to go to Officeworks and Bunnings. In fact, even when there's a recession, people will spend their time and energy on home improvements rather than traveling. So it's a really good staple play if you think a recession's coming. Another example is Woolworths Group, WOW, which again owns Woolworths and a whole bunch of other consumer staple businesses. People always need food and will always buy food, even when the economy is crashing. So they're a really good share to hold because they're just a fundamental. They just need it all the time. Let's look at them again. $63 billion turnover, net profit of $1.6 billion, dividend of 94 cents a share, price earnings ratio of 42, it's a little bit high. People obviously think they're going to grow, yield of 2.37%. Another point to make is don't get fixated on the individual price of a share. So as an example, Woolworths is $39.53 when I'm recording this. Wesfarmers is $50.23. The price difference between that company, those two companies, doesn't mean anything without any other information. It doesn't matter if that's 50 and that's 30. It's more about the ratios and the returns. So don't think I'm not going to buy Woolworths because Wesfarmers share price is higher, because those numbers are meaningless to be compared to one another. Again with the ETFs, I want to be exposed to the tech sector, especially the global tech sector, because it's absolutely going gangbusters at the moment. but I don't want to physically have to own shares in Google, Apple, YouTube, Snapchat, etc. I don't want to deal with the ramifications and having to keep up with it. I can look at an index fund called Tech.asx. So that's a global tech ETF run by Morningstar, which is a massive investment company. All they do is mirror holdings in global tech companies. So the thing with Tech.asx is I can literally look up the allocations right now and tell you that they've got exposures to Uber, Palo Alto Networks, F5, Arrow Electronics, US, Germany, Israel, Japan. So I'm getting exposure to global technology without having to do anything. I'm also kind of hot on Australian tech as well. So I found this other ETF called Betashares Australian Tech ETF. This one only invests in rising Australian tech companies. It gives me exposure to all of them without me having to go to the effort of doing all the research and figuring it out myself. There's basically ETFs with exposures to pretty much everything you can think of. Property, commercial property, small companies, big companies, Asian companies, Australian companies, anything. So if you think longer term that there's a certain trend you want to follow, think about getting on an ETF rather than looking for individual shares. Another note overall is when I think about putting a portfolio together for longer term, I'm talking like 90% conservative slow, 10% interesting crazy stocks. 90% of my portfolio is just ticking along and 10% is like a punt. So as an example, I took a punt on the company Afterpay when they were $6.49 a share. Now they're like 100 and something, which is great, but it was nearly equally likely that they would not do anything. While those wins are nice, those wins aren't a sustainable long-term investment strategy. They're basically a bit of a gamble, but I'm prepared to essentially gamble 10% of my portfolio, not 90. Leave in the comments any interesting shares or funds that you like or anything you think about. I'm always happy to chat about them. And remember, this isn't specific financial advice for you. This is general examples of how the share market works and how ETFs work. Always think about your own goals and have a chat to a financial advisor if you want to get serious about it. Thanks.